Debt cycles are powerful forces, shaping economies and financial markets. Debt is inherently cyclical because it allows people and businesses to spend more than they earn in the short term, while requiring them to spend less later when they must repay it. Let's break down the two key types of debt cycles and their impact on investing strategies. The short-term debt cycle, often called the business cycle, lasts about 7 to 10 years. It moves in predictable phases. 1. The economy slows down and central banks lower interest rates to increase spending and stimulate growth. 2. Lower rates encourage borrowing, increasing spending and investment. Demand increases relative to supply and leads to inflationary pressures. Asset prices rise and economic growth accelerates. 3. As demand grows, inflationary pressures build. To prevent overheating, central banks raise interest rates and tighten credit, slowing economic activity. 4. Tighter credit slows down spending and investment, leading to a downturn or recession. This cycle repeats, creating periods of expansion and contraction in the markets. The long-term debt cycle unfolds over 50 to 75 years, consisting of multiple short-term cycles. Over time, debt levels accumulate because governments, businesses, and consumers continually borrow to fuel growth. Central banks lower interest rates to make borrowing easier, but eventually rates reach zero or near zero, limiting their effectiveness. At this stage, policymakers turn to quantitative easing, printing money to buy assets and inject liquidity into the economy. However, as debt levels become unsustainable, the ability to stimulate with lower rates or money printing weakens. Economies face a major turning point, leading to deleveraging, devaluation, or economic restructuring. This happened during the Great Depression, the 2008 financial crisis, and might happen again. To sum up, the short-term cycle creates market booms and recessions, while the long-term cycle determines major financial shifts and economic restructuring. So how can investors use this knowledge to refine their investment strategies? Monitor central bank policies. Central banks play a critical role in driving debt cycles. By closely following their actions, whether raising rates, easing credit, or printing money, investors can better anticipate market movements. In early expansion phases, when rates are low, stocks, crypto, real estate, and other risk assets tend to perform well. At mature stages, avoid chasing market highs fueled by excessive credit. Instead, focus on undervalued assets that will benefit from the next cycle. Understand the role of inflation. Late in the long-term debt cycle, inflation can erode purchasing power and force policymakers to raise interest rates to cool down the economy. Investing in risk assets in the period of raising interest rates is not a good idea, as the valuation of risk assets is often dependent on the availability of cheap credit. As rates rise, shifting to defensive sectors and fixed income investments can protect against volatility. Commodities, gold, and inflation-linked bonds can help hedge against rising prices. Debt cycles are an unavoidable part of economic and financial markets. By understanding how they work, investors can navigate booms and downturns and align strategies with where we are in the cycle.